Good evening, everybody. Still a nice summer evening here in Mars, PA. Doing good tonight. All right. All right, we're going to kind of run through. A lot of people have been asking what the training this weekend is going to be all about. And so this is kind of going to be what do I say? This shift notes of shift notes. Still cold there in Texas, Janie. Geez. Cliff notes. There you go. Let's see. They did run the 2 miles. Is it two? No, it's not 2 miles. 2 minutes. Um, at the Kentucky Derby. Yeah, my doctor, when I went in, he said you need to run 7 miles a day. Check back with me later. See how you feel. I called him back a week later, and he says, "Well, how do you feel?" And I said, "I'm cold. I'm hungry, and I'm 49 miles from the house." So, so the option training. The what we're going to go through again. This is kind of reviews that we know what the drawbacks are of trading good option or making good options trades. You need to be correct in direction, the timeliness of the move, and the magnitude of your move. The benefit we have from candlestick analysis is it gives us a high probability of the direction, the timeliness of a move, and the magnitude of the move. So if I've got people asking if we don't know too much about options, should we be doing this? And the answer is yes, because we're going to be going right from the very start of what you do when you're buying calls and puts, how you write calls or puts against your positions. A lot of people ask, well, how do we know whether we should be buying in the money, at the money, or out of the money calls? We're going to be going into that just based upon if we're applying the information of the trade to the dollar, not the dollar, to the chart, then we can make much more, I want to say, viable decisions as far as which options to trade and which strategies, whether we want to buy calls and puts, whether we want to buy call spreads or sell put spreads. We want to be able to use that time decay in our favor based upon the direction. We want to know which strategies to use coming out of a breakout and what other strategies to use as the position is moving. That's true, Bill. Yep. So some of the benefits of the options, obviously, are if you're trading higher price stocks, you're much better off trading the options. Also, it allows you to limit your market exposure. We can use it for hedging, which is not necessarily what we want to do when we're using candlestick analysis. We're not trying to hedge, we're trying to take advantage of the directional movement that we're seeing in the charts, and it helps us with doing some downside protection. So, excuse me. So as we saw the other day, this was what, 5 days old now, that when we saw that gap up in the overbought condition, we can be much more prepared to put on a trade that would help us or because we know what should happen based upon human nature. When they're gapping up in the overbought condition, you get ready to start taking profits if you own the stock. If you're trading options, and let's say you do own that position and you don't want to sell it even though you know it's backing off, setting up, writing the calls that you could have been, darn, I meant to put the price on here, selling the 140 calls for 540, which means if it goes the opposite direction, that's extra money put in your pocket. These are the type of strategies we have much better insight into what to do based upon knowing what human nature is doing. As far as CB, you always, let's see, he can't hear me. Becky, can you type in for CB to check his speaker icon underneath the participant name on the left? You could have done that too. That's the other, yeah, that's going to be the other scenario, Magic, is whether it's time to buy puts. Now, there's a difference between if you were long this position, you're writing calls against your position, but because we didn't know what the magnitude of this downtrend might be until this day, that's where you might have written calls, and then 2 days later, you might have bought some puts against your position. Or a bear call spread. So that's what we're going to be going through. Now, when we do spreads, one of the things that we have to really be concerned about or pay attention to is the liquidity, the open interest of the options you want to trade. And the reason I bring that up is I had a very good trade in last month. I had a spread on LVGO, and if I can just pull the numbers off the top of my head, I want to say I had a 50-55 call spread that I think I paid $1.85 for, with the expectation that it was going to go to $5 with any closing above $55. Well, it shot up to like 62 to 65 very quickly, which meant theoretically those calls should have gone to somewhere around the 4 to, or that spread should have gone to about the 4 to 420, 440, somewhere in there. There's still going to be premium on both, which makes it wouldn't be exactly at $5. However, the disadvantage of that spread was I didn't check out the open interest on the both sides, because the problem with closing out a spread, as well as the problem of putting on a spread, is if you're putting on a spread and you tell the or if the system, which I use Thinkorswim, says you can buy them for $1.85, that's the theoretical price. But if the open interest on one side or the other is not very big, what you have to be waiting for, whether you're trying to get in or out of that trade, is that somebody's trading volume or trading, there's trading going on both sides of that trade at the time that you want both sides of that trade executed. So just throwing out the numbers, let's say there was open interest of 400 on one side and there was open interest of 60 on the other side. Well, you might not be able to close out that trade because nobody's trading the 60 at the same time. They're trading the price at the that has bigger volume. Anyways, I know that's pretty. So basically, in a nutshell, you have to have enough volume or open interest that you can get in and out of those positions at the same time when you're trying to close out that trade. So that's going to be one of the things we look at. We also look at the time factor. How many weeks out? I have kind of a basic rule that if I'm 4 weeks out or so, I'm just buying the calls or puts. If I'm doing a debit spread, somewhere between 2 and 3 weeks out, for that exact reason that if a price moves substantially strong after you put on the spread, so let's say you bought a 50, 55 and it goes to 65 very quickly, the spread doesn't necessarily mean it's going to expand out to that $5. It might, you may have paid $1.85 for that trade, to put on that trade, and it might be trading at $1.90 or $2.15 for the next 2 weeks until it gets closer to expiration day, just because of the time, or because of the time premium. Charles, yes, usually, but that's on the stock. What is the minimum daily volume for you to enter? I usually try to look at the open interest, and but again, that open interest is going to be a direct function of what the volume is on the stock, how much stock is traded each day. So, like Charles is putting out, usually I like to see stocks that are trading 1 million shares. If I've got a $90 stock that's trading 530,000 shares a day, that's not bad if I'm putting on a stock position, but the option volume might not be big enough to put on a trade. So there's a couple ways, and again, we're going to go into this over the weekend, is how do you decide whether to put on that trade with options? It's not a case of whether the trade is good, meaning if you see a stock price that has a very good chart to it and you're deciding to buy the options, well, if you can't get into the options, if the bid-ask spread is large, that means there's not a lot of volume. Unfortunately, the bid-ask spread has expanded because ever since they've told us that they're not charging commissions, all that means is they expand the spread. So you're looking at a spread that they might be bidding $2 and asking $2.60, and you know the true market is somewhere around $2.30, but you don't know what it is because you're not being shown. So you might have to buy that. If you're buying, you might have to buy at $2.40 or $2.35 when the true market was at $2.30. So they're picking up the inventory at $2.30 and giving it to you for $2.35. They're making money. Don't worry. A brokerage firm that's making money by doing trade executions is not giving you free commissions. Oops, let's see. Let me go back up here. It seems the bid-ask spreads are going to, yes. Oh, yeah, Jeff, yes, that's exactly what. Yeah, so they're clipping you because you can't see what the true market is. It seems as yep. It's like trying to trade stock with a low flow. So I was getting to the answer. If you can't put on a trade, even though you see the price of the underlying stock has got a good movement to it, if you can't get into the options at a favorable price, then you move on. You're in the business not to force a trade. You're in the business to make money, and if you can't make money off of that trade because of the playing field, move on to something else. Oh boy, FT, it all depends. If I'm buying 2 contracts or something, it might be 250. If I'm buying 50 contracts or something, I might want to see in the thousands. Okay, can you hear a CB? All right. Can't you roll the one you sold? Errol, I don't understand the question. Meaning, do I want it to all right. Do I want to change my trade prospects or my trade setup as the trade is going? A lot of people say, well, if it's moving up big, can you go ahead and close out the one that you sold, buy it back, and just hold the long? That wasn't the point of making that trade. I'm more than likely will keep that trade on, and if I think the it's moving higher, I may just go ahead and buy more calls. So I've got the spread and calls going on. And that's, again, another strategy that we'll be talking about. And somebody be on the other side. Someone has to, yes. So if there's not enough volume to be able to do a spread, that somebody's on isn't going to complete that spread for you, go someplace else. If the price moves too fast, Earl, if you're already in it, yeah, you can always do something to enhance that strategy, which is one of the things that we will be showing. That's going to be a basis of if you've got a fry pan bottom that you know the price move is going to be very big, maybe your initial trade is going to be buying calls, and as you see the pattern forming and you think it's got big upside, now you go up the ladder a bit and maybe do some spreads at a very low price, that if it does get up through that level based upon the fry pan bottom having a big price move, that little bit of money you've got into that spread now expands dramatically for big returns. If it doesn't, you don't have very much money exposed. Yeah, there aren't any. Well, there are some market makers in options. The brokerage firm will usually, at one time, if you showed an ask or a bid, that meant you had to execute at least 10 contracts. Now, that was years ago. They've changed the rules so many times, I don't know if that's still the case. How does that affect the time? The debit or the credit spreads are very profitable. And again, this is what we're going to go through on Saturday, is the debit or the credit spreads usually work extremely well on a very short time frame. They don't make a lot of money, but the probabilities of them making money are extremely strong. So you can make a consistent income knowing which direction the underlying stock is going and where it's probably going to move in the next 3-5 trading days. So, and I'll show you the benefits of the credit spreads here in a second. Obviously, we know the spreads have leverage, where if we were just buying calls outright, thinking that a 50 call is going to, the stock is going to 55, we're paying 250 for it, and it goes to 5, we made a 100% gain. But if we did a spread where we bought the 50 calls and sold the 55, bought the 50 calls for 250, sold the 55 for $1, so we only have a net of $1.50 in it. Now, if that price goes to 5, we've made a much bigger percentage gain with less money exposed. And additionally, the break even on the first trade, just buying the calls at 250, you'd have to go to 52.50 just to break even, and your break even on the spread is 51.50. So what we're going to be able to illustrate, especially knowing the direction, is making the relevant decisions. How much time do we have to expiration, and which strike price is the best to go after, and or the combination of those. Yeah, if you have a level 3, but that's for a very short time frame. Let's see. So again, if we see a pattern, like our J-hook pattern, you can kind of calculate what the next move is, how long it might move. So if I see something like this, where we can see that our next move is probably up to the resistance level of the 200, and we're buying calls down here, I guess I use this as an illustration and I don't have the numbers, but if you bought the calls March 17s or 1700s for 930 and it goes to 1730, those calls go to 30 bucks, made a little over 100%, 200%. But if you did a spread, the magnitude of that return was much bigger with a lot less money exposed. So this is what we want to show everybody is a spread versus a straight call. Now, the reason I try to put my trading strategy out so everybody can kind of learn it is we're not trying to be complicated. First of all, we know that analyzing the candlestick charts is relatively simple. It's all visual. You don't need to have a lot of indicators. So the second thing you don't want to do is find a good trade and then have to spend 20 minutes to figure out what strategy to put on that trade. We're going to take a look at the condors or the straddles, the strangles, all those sorts of things. That's just to give everybody a definition or the terminology or description. But the benefit of candlestick signals are that it gives us a directional move and a magnitude move indication. Those are what we want to use very simple trading strategies, which will boil down to buying calls and puts, buying bullish spreads, selling credit spreads, or a combination thereof. And that's where the combination comes into play. So there are times when a credit spread are much more favorable than buying a bullish spread. It's when the calls or the call spreads are too expensive for the amount of time you've got left to expiration. When the target doesn't make sense for a bullish trade feasible, and or if the market is getting a little bit iffy, not necessarily meaning ready to turn over, but just not going up very much more, you might be much better off doing a short-term credit spread. So a bull spread, I don't have the numbers on here, just this bull spread, I mean, if I can make a good 162% profit by buying one call and selling the other, well, what do I have to have done? I have to have that price move in that direction. Where at the same time, if I put on a credit spread, it doesn't even have to move in that direction to make a good return. That if it stays above this price, we're still going to make a very good good profit. So this is what the whole weekend's going to be about. First of all, the market's doing, what stock price patterns, or knowing the stock price patterns, then knowing whether we want to put on calls or puts, buy the spreads, sell the spreads, or the combinations. So with that, let's see, let me put this up here. This is the sign up page. This is the, if you're a non-member, and then obviously a member, it's the discounted price. What has SoftBank been doing to mess up the markets? Any simple answers? I don't even know what SoftBank is doing. Okay. Again, this weekend we will start with the basics of candlesticks, which even if you're a sophisticated investor, I've found that when we go through the basics, somebody remembers or discovers something they didn't have full clarity before, and it just kind of sorts out which trading strategies might be better. The members is, I think, 197. This is advertised as a 4-hour training, but I always warn people, figure on 5.5 hours minimum. Okay, so let's take a gander at what's been happening in the markets. Whoops. That's not where I want to be. That's not where I want to be. Oh, that's what I'm trying to do, is get the chart in here. All right. Disagree. Exchanges have subsidiaries and competitive houses that make markets. Yeah, I have a good buddy that helped write one of the programs for a very profitable trading firm in Houston, where they they would have access to all the exchanges, and they would be able to take advantage of any disparity in prices. Meaning, if a stock was being bid at 100 and asking 100 and 100 and oops, just to round it off, they were bidding 100, they were asking 101, and then somebody came on the Pacific Exchange and was selling that stock for 99 and a half. Well, their system would immediately buy that stock at 99 and a half and immediately sell it on the other exchange for 100. So they picked up 50 cents. Doesn't sound like a whole lot, but they would do thousands of those transactions every single day. So it produced a lot of money. So there is this disparity, not that's a difference between one market and the other. Thank you, Janie. Oh yeah, that's why we try to keep it simple. I've got friends that back in the old days, which is years ago, what was it, Options University? They would spend $5,000 for a training session on trading options. But then they felt they knew less when they got done with the training than when they started. So they take the next session for $5,000 to clarify what they thought they should have learned. And at the end, they would know less. They would go through $25,000 on training, learning how to trade options, and it was made so difficult that they couldn't understand how to make money. This training in 4 hours plus is keeping everything simple, because at the end of the day, if I see a good trade, I don't want to be spending hours trying to figure out how to take advantage of it. I want to spend the next 3 to 5 minutes figuring out which strategy would be the best. Let's see. Let's take a gander here real quick. The market. Here's the T-line rule. Anytime you see a candlestick sell signal to close below the T-line, the probabilities are that you're in a downtrend. Now this, I want to make this very poignant. very compelling. The T-line rule. If you see a sell signal and a close below the T-line, the probabilities are extremely strong that you're in a downtrend until you see a buy signal and a close back up above the T-line. So remember yesterday, the market just turned around and blasted up. But what was the one thing that it didn't do? It didn't close above the T-line. Today, it opened positive again, showed strength. But as soon as it came back down through the open, even though it was still trading positive, we could see graphically it was not coming up through the T-line. How do you plot the T-line? It's the 8 exponential moving average. You put it on your chart just like you would the 50-day simple moving average. All charting services have that option to put on moving averages. It's a standard indicator on, no, it's the 8 exponential moving average. We call it the T-line, short for trigger line. You're trying to figure out a name for it. The 8 exponential, yes, EMA. Mark, I can't explain it. It's one of those things that has Fibonacci characteristics, meaning it acts like a natural support and resistance level of human nature. And it's not, the reason it is, it's not a natural number, but here's the most important statement that I usually put up as a slide in the presentations, that if the candlestick signals are the graphic depiction of human nature or of investor sentiment, and the T-line, for whatever reason, acts like a natural support and resistance level of human nature, when you combine the two, you've got an extremely powerful combination. Now, why the T-line works, have no idea. Yes, the 8 exponential has been used for years in the commodities market, and it works. Now, here's the great benefit of candlesticks is candlesticks work. Seeing the signals gives you an extremely high probability there's been a change of investor sentiment. With that, anything else that you add to your chart should be enhancing the probabilities of those signals. So we've tested it. As a matter of fact, this was introduced to me by one of my first private training students, Rick Sadler, who now runs hit and run candlesticks, where they do scalping using candlestick signals. But he called me about 6 weeks after we did our session. He came down from Anchorage, Alaska. He said, put the 8 exponential. There's one very, very observable result. But as long as you see a candlestick buy signal, let me find something that see if I can find some. You see a candlestick buy signal and a close above the T-line, you can stay long as you don't see a candlestick sell signal and a close back below the T-line. So it has a very simple rule. If you see a candlestick sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. Conversely, if you see a candlestick buy signal and a close above the T-line, you stay long until you see a candlestick sell signal and a close back below the T-line. It works for all time frames, yes. This could be this is a daily chart. If you went to your, go to the 10-minute chart. It works on your 10-minute chart. So remember, the signals are the graphic depiction of everybody buying and selling during a specific time frame. So it doesn't matter whether you're looking at a 1-minute, 5-minute, 10-minute chart, or a daily, weekly, or monthly. And the T-line is the graphic depiction of human nature during that time frame. So it works on all time frames. Yeah, it is a Fibonacci number, but the important factor is, and this is where I tell people, don't take my word for it blindly. Put it on your chart and then start watching. You'll find that people that use the T line see that it's very, very effective for analyzing a trend, to the point where, being the worst investor in the world, when I came across candlesticks, it turned me around to where I was making money. Now, I got whipsawed out of a lot of positions because I'd see a candlestick sell signal and I'd say, all right, let's close it out and move on to something else. But then I discovered, if you look at the candlestick signals and use the T line, it keeps you from getting whipsawed out of positions that might be a sell signal, as long as it didn't close below the T line. All right, so let me run through some real quick here. This is what how do you know when it's a buy signal? RW, that's the bricks and mortar, the bread and butter of the whole reason to be analyzing or learning candlesticks. There's about 50 or 60 candlestick reversal signals, but you don't have to spend your mental time and energy learning all 50 or 60. We've narrowed them down to 12, or I've narrowed them down to 12, 6 longs and 6 shorts. And once you know those 6 long and 6 shorts, you now have a much better grasp of when a price reversal is occurring. Now you can add other indicators, like here's kind of our morning star type signal, a doji right on the 50-day moving average, stochastics in the oversold area. This is how simple candlestick concept is. The Japanese rice traders say, if you see a candlestick buy signal in the oversold area, the probabilities are pretty strong you're in an uptrend. If you see a candlestick sell signal in the overbought area, the probabilities are pretty strong you're heading down. Then you add the concept or the indicator that if you see a candlestick sell signal and a close below the T line, you know you can stay short until you see a candlestick buy signal and a close above the T line. But there's one caveat to that, which isn't on this chart. It's on this chart. If I can find it. Am I on the right? You can stay long. Where is it? Where is there? It is right there. Because this is the natural support and resistance level of human nature, you can stay long as it stays above the T line. Well, the Japanese rice traders also have a very simple analysis. Where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. So how do we know when exuberance is coming into this trend? They're starting to gap up in the overbought area and starting to move away from the T line. So the caveat is, the further you move away from the T line, the higher the probability it's going to come back and test it. So a while back, we had people in the options room that had good option trade, started getting real exuberant. Now, it moved all the way up here. This is Tesla. Way up here. Look how far away you are from the T line. So now we have a different trading strategy. If we know we're too far away from the T line, but we haven't seen a sell signal yet, we just flip to our 10-minute chart and watch to see when the 10-minute chart starts showing sell signals and coming back through the 10-minute T line. That's when you take profits. So the caveat is, the further away you move from the T line, the higher the probability it's going to come back up and test it. So that adds more credibility to your reversal signals. So here's Tesla today. It gapped up yesterday, producing a very strong indicator. and then opened positive today. But what was the final result? They couldn't close above the T-line. The 3T line is, yes, this little green line also works in conjunction with the T-line in two ways. The further away you move from the T-line, the more the 3T line becomes your a good indicator. Or if you see a buy signal and a close above the T-line, if the 3T line also comes up above the T-line, that's just a little bit more added fluff. I've been using EMA time frames for quite some time, but didn't realize that was the T-line. Oh, it's not that it was the T-line. It's just we named it the T-line just to give it a shorter name than the 8 exponential moving average. Fade, it's just visual. If you can see that it's kind of close to the T-line, then all of a sudden it's starting to move a little bit away from the T-line and you're up here in the overbought area. It's just relative to what the normal trading should do. Okay, let's run through some of these. This is why the patterns are much more effective than just buying uptrending stocks during an uptrending market. We recommended Tupperware a while back because of this fry pan bottom. And look what it's done. Notice what the market has done over the last 3 days. Look what Tupperware has done over the last 3 days. Same thing with Abercrombie Fitch. There's a J-hook pattern. And notice what it's done over the last 3 days. It backed off a little bit today. But the reason we can buy the patterns is because they are the buildup of investor sentiment. Our recommendation on HIB was based upon there's a left-right combo, a doji followed by a bullish engulfing signal. And what was added credibility to that signal? They weren't closing it below the T-line. So you have wave 1, wave 2, wave 3. Look what wave 3 has done in the last 3 days when the market itself has been selling off. Oh. No. Remember what a doji sandwich is. This would have been a bullish flutter kicker had it opened here and went positive today. But this is just a nothing. It's not a signal of any sort. You don't have a dark candle gap up and then another dark candle. That's nothing. Let's see. We've been in this one. Because of the slow curve fry pan bottom, look what it's been doing even in this bad market. A shooting star? No. Remember what the makeup of a shooting star is. The tail has to be 2 times greater than the body. This is just kind of a down day in an uptrend. No real signal. Now, it would have been a dark cloud had it closed more than halfway down this candle, which it didn't do. And look at what it's still doing. It hasn't even closed below the 3T line, let alone the T line. So logic says if it hasn't even closed below the 3T line, it's definitely not closing below the T line. And if it's still above the 3T line, that means it's still got good strength to it. This is one that we've made lots of money on. This is why you want to know the 6 or 8 patterns and the 12 major signals. Look at our big cradle pattern right here. And what did this candle do? Took us out of a big series of indecision and closed above the T line. What happened after that? Got a big fry pan bottom. And what's our fry pan bottom rule? You just stay long until you see a sell signal and a close below the T line. And so far this hasn't closed below the T line. So this one we started buying calls here in the $25 range and started taking some profits up here. But also along the way, we took profits on the calls but then we would augment our returns by buying some spreads as this kept moving up. So the further we moved up, the higher the risk. But if we put on spreads with little money exposed, that if it kept moving up strong, that 60 or 80 cents you might have bought on a spread now has the potential of going to $5. Well, Mark, no, we don't have a sell signal on this one yet, and we're still trading above the T line. Gary, yes, if you can't make it through the whole thing is recorded. So if you doze off at the desk and plop onto your keyboard, the next day Abe will send you the recording. WK Workhorse. There's your fry pan bottom. Look what it's done over the last 3 days. Now it backed off today, but again, what's our rule about a fry pan bottom? You stay long as it doesn't close below the T line. Oh, I imagine the Tupperware is on the New York. Pretty much, if a stock has two or three letters in it, it's on the New York Exchange. If it has 4 letters, it's usually on the NASDAQ. I say usually on the New York Exchange. It could be on the S&P also. No, not the Dow, the New York Stock Exchange. The Dow only has 30 stocks. So if a product has an ATR of 2, how does the correlation to the T line? Could a product be an ATR 3 correlate? Flat? I don't even know the answer to that. It has no correlation. The T line is what we're using. On Shill, what was your thought process holding it through the long wick below the T line? It could have wiped out most of your profits. Yes, it could have. Had it closed down here, that would have told us a completely different story. So if something's selling off for no reason, I'll just wait to see how it closes. Remember the 2 most important factors for candlestick charts for the Japanese rice traders. Where did it open and where did it close? Everything else is noise. Yes, it is too late to buy Tupperware, and I'm glad you asked that because everybody asks that type of question. So this stock coming out of the fry pan bottom, kind of right here at, let's say, the 15 area, and now is getting up close to the $25 area. It's moved 75%. So this is the whole purpose of candlestick analysis, is where do most people buy? They buy exuberantly at the top. So what do we want to look at for this? What's the, what do you call it, the learning moment? Is you want to ask yourself, what made this move? This right here. So this is what I want to be looking for. But not so for, no, but it's not finished yet. We're still in the uptrend. We're just now coming out of but not, yeah, it's not, well, I'm sorry, what you're saying. Yeah, this may not be too late. We're already along some of the calls, but if this comes back up, holds the 3T line and basically comes up, what's our expectation? What's our expectation coming over the fry pan bottom? A big price move. Maybe wave 1, wave 2, wave 3. You can, and that's where you pick up the different strategies. But if, let's say, it did back off tomorrow, hit the T line and start bouncing back up, you might go in after it at that point. Okay, so not only do you want to pick out the strong charts, but you also want to go with the flow. We recommended CNK because of the doji close below the T line, and look where it went to. The first logical target was the 50-day moving average. So what's our analysis at this point? Well, it might support on the 50, but stochastics are still heading down. At least now we have a playing field or a program or a plan. If it opened positive and closed here, doing a bullish harami, what's that tell us? The selling has stopped right here on the 50. We probably want to close out our short. If it opens lower, what's it telling us? The 50 is not acting as support. Stochastic's still heading down. What's the next target that everybody's probably watching? Right somewhere down here in this range. Now, why is this a more viable trade? Because if you're looking at the markets and the markets are selling off and you've got a stock that also is showing sell signals and selling off, just put 2 plus 2 together. That's the right way it's going to be moving. It has a long way to go in comparison to historic pricing. CB, yeah, but we're not buying something based upon historic pricing. We're buying on what is the information telling us right now about this chart. Coming out of a fry pan bottom, we're in a fry pan bottom breakout. If it comes up here and sells off, we're taking profits. How long do we hold this? Until we see a sell signal and a close below the T line. Do you set up stops when you enter a trade? Do you move the stop up every day as stock moves up? I do once I'm in the overbought condition. So right now I'd have a safety stop at today's open on Tupperware. Because if there's enough selling pressure to bring it down through this level, where do you think they're heading to? Back to the T line. On the other hand, if I'm buying something because it's breaking out and doing what, that's not the right one. Which one was it? It was overstock. Make this bigger. Doji, spinning top in the oversold area, and they gap it up. So you gapped up, doing a best friend signal, trading up here. What's it doing? It's doing a gap up and trading above the T line. But at the end of the day, when it came back down through the open, that's a good place to put your stop for 2 reasons. Because that tells you the bears are now back in control, number 1. And number 2, it's telling you they're not closing above the T line. What's our trading rule about the T line? If you're closing below the T line, the probability is still strong that you're in a downtrend. I don't use Bollinger Bands, but you can. I mean, use whatever you want. I know some people in the chat rooms use the Bollinger Band to see when the squeezes occur. And when that Bollinger Band gets real thin and you see a buy signal, that gives you gives some people that are trading the Bollinger Bands that much more insight that there might be a breakout about ready to occur. Did I do Zoom? Zoom was also your best friend signal, gap up yesterday. Even though it backed off today, you're still in a J-hook pattern. You're still above the T line. Now, the rest of them, like Apple, notice where it opened today, right at the T line, and started to trade off. What'd that tell us about going long? Definitely didn't want to go long because it wasn't looking like it was closing up above the T line. Crypto, meaning the Bitcoins and that sort of thing, yes. Candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. It doesn't matter whether it's stocks, bonds, currencies, commodities, tulip bulbs, anything that has fear and greed. That's what the candlestick signals illustrate. So it's good for all trading markets. Tesla, another one that couldn't get back up above the T line. Netflix, you can see the evening star type signal. There's your doji, harami, close below the T line. If you were long, you definitely wanted to be out here, if not right here. And right now, if you're short, you can stay short. And NVIDIA would be a buyer of this one today had it opened positive and started trading positive. Or if it had started opening positive and trading positive and closed here, you closed it out, because what's our probabilities? We're still back below the T line. You want to get back out of that trade. So a lot of people ask, well, how do you set your stop losses? And that becomes very simple using candlestick charts, because it tells you when a trade is not working. Also, it tells you, which one did we just do? Not Zoom, Overstock. But if I had started buying this one today and it closed here, I'd close it right back out. And this is why this weekend we're going to be doing an option training on September 26th. We're going to be doing a full day training on how you keep your emotions out of your trading. And because candlesticks are basically the graphic depiction of high probability trade setups based upon human nature, which doesn't change after hundreds of years and will not change for the next few hundred years. If you know what the probabilities are doing, it gets you out of bad trades quickly. The old sage advice that you cut your losses short and let your profits run, which every money manager tells you for as sage advice. Problem is, in the 40 some odd years I've been investing, I've never heard money manager tell you how to cut your losses short and let your profits run. It's very simple when you're using candlesticks. Do you have candlestick training? Yes. I don't know when our next one is, but RW, if you become a member of our website, we have a Monday night session just like this for members, the Thursday night session, which you're getting exposure to the different signals and patterns, and then we have a chat room that's open all day long where people are discussing which charts look good. And I put out 2 or 3 stock picks every night, and we do it in about a 2-minute format, video format. But I tell people it's not so that you have stock picks. It's so that you can see what the logic is or what the rationale was for that based upon that video of why that stock is being recommended. It goes back to the old theory that if you just tell people what to do, they don't learn anything. I always illustrate that with the cop that's standing on the street corner, and he sees this drunk weaving down the street, blows his whistle, pulls the guy over, walks up to the car, and in the back seat there's a penguin sitting there. The cop says, "What the heck you doing with a penguin in your back seat?" Drunk said, "Oh, I found him out on the street and I don't know what to do with him." And the cop said, "Well, take him to the zoo." Drunk said, "Oh, I didn't think of that." Next day, the cop's standing on the street corner. Here comes this drunk, weaving down the street again, blows his whistle, pulls him over, walks up to the car, looks in the back seat, and there's a penguin sitting there. He said, "I thought I told you to take the penguin to the zoo." Drunk said, "I did. He liked it so much, today we're going to a baseball game." So if you don't know why you're learning something or doing something, you don't learn anything. That's right, Mark. Okay, so the T-line has worked very effectively. We're looking at Penn. Look at the slow curve on Penn, and it broke out today. If this opens positive, you're now probably in wave 1, wave 2, going into wave 3. How did wave 3 start? There's your little left-right combo, close at the T-line, bullish confirmation. Now you've broken out. Stochastics coming up. AQST, left-right combo. I have the 34 on here. Here's my moving averages. The 200 and the 50 are simple moving averages. That's because every major money manager around the world uses those two moving averages to make their decisions about their portfolio. We put them on here. A lot of people say, well, why don't you use the exponential? They're better. We're not using these to make our decisions. We're using these to see what everybody else's decisions are at these levels. The 34 EMA works reasonably well enough to put it on the chart. Then your T line, the 8 exponential moving average, and the 3 T line, confirming the T line. That's about as simple as you need to have your chart set up. Stochastics, very simple. If you see a candlestick buy signal in the oversold area, the Japanese rice traders say you're probably starting in an uptrend. If you see a candlestick buy signal in the overbought condition, it doesn't mean very much. Or if you see a candlestick sell signal in the oversold area, it doesn't mean very much. They need to be occurring in the appropriate place. Yeah, the 34 is another Fibonacci number, but it's, again, just you put whatever on your chart. If somebody says put the XYZ indicator on, if you put it on and it doesn't do anything to enhance your returns, take it back off. Don't clutter up your chart. And CYRX, there's a J-hook pattern in progress. Look at your little doji right here on the T-line, bullish confirmation. This one you can get ready to buy on positive trading tomorrow. Now I say positive trading. If this opens positive, you want to be buying it. But that's probably also going to be a function of how your pre-market futures are setting up. Stochastics are 1233. Slow stochastics. Bullish engulfing on XNCR, another one that can be bought on positive trading. If it opens positive, what do you expect happening? A doji sandwich breaking out of this level. Fry pan bottoms, DAR. Oops. You can see the fry pan bottom. You can see the doji right up here. If this opens positive, remember our doji rule. It's going to move in the direction of how they open after a doji. And if they do open positive with the magnitude of the next candle being the same as this one, what's it tell you about your breakout area? You're probably in wave 3. Do you base on opening or wait 10, 15 minutes for the noise to die down? We'll do we do entry strategies. If the market is opening positive and the stock that you're looking at is opening positive, confirming a buy signal, I'm probably buying within the first 90 to 240 seconds. If the market opens lower and the stock you're looking at is opening positive, I'm going to wait to see if it's going to move on its own or whether it's waiting for the market to turn around and head back up. But there's 4 different quadrants that allow you to improve the probabilities of being in the right trade at the right time based upon how the market opens and how the stock price you're following opens. Pack, you can see that fry pan bottom. Look at your doji sandwich breakout. Now look how far away you've moved from the T line. So what's your strategy at this point? First of all, your safety stops right here. If it gaps up and moves up again, look how far away you'd be from the T line. That's when you flip to your 10-minute chart. Charles, what you will find about candlestick analysis, which I found out about candlestick analysis, is it is mirror merely common sense put into a graphic depiction. It gets rid of all your, and another factor is, one simple statement I make is prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And that's what the graphics of candlesticks are, is what is everybody's perception of what they're looking at as far as information. So there's kind of your J-hook pattern on NVCR, another viable trade setup. And a lot of people were asking what to do with this one because it's whipsawed so much on Nikola. So I tell people, if you look at a chart and you can't tell what it's doing, you don't want to be in it. Move to some place where you got a much better view knowing what type of signal is forming. Peloton just announced good earnings today. And look what it did. So this is why the graphics of candlesticks is much more important than what the news is telling you. Because whatever the news was, when they reported good earnings, it sold off. Why was that? Apparently it wasn't as good earnings as some people were expecting. And go-go, there's another J-hook pattern. Looks like this is what we call the classic pattern. Fry pan bottom breakout. What do we expect coming out of a fry pan bottom? A strong price move. Now it's setting up for a J-hook pattern. What's the prerequisite for a J-hook pattern? A strong price move, consolidation, and we can tell this is consolidation versus selling because notice how the pullback is very indecisive. Oh, that's right. I think they were up a little bit. Maybe I shot or that's right. They announced afterwards. So you'll have to see how it opens up after or tomorrow. But so what do we expect here? A J-hook pattern. What's our price move expectations on a J-hook pattern? Wave 1 and wave 3 are usually the same magnitude. Now, I might not have been buying here, might not have been buying here, but I will be buying here because it tells me what pattern is setting up with a high degree of probability. On the other hand, if the market opens up weak tomorrow, there's a bearish left-right combo. We're sitting right on a support level. If it trades lower on B core, you want to be going short. Fastenal, there's your bearish best friend, doji down. If they trade this one lower, where do you think your next target is? That now that they failed the 50, probably all the way down here to the 200. So this is not rocket science. This is just being able to graphically analyze what's going on in investor sentiment based upon what the Japanese rice traders have told us for 400 years are signals and patterns, and then being able to watch to see what happens at levels everybody else is watching. Another bearish best friend on SMAR. Another one that if it opens lower tomorrow, you can definitely be shorting this one. Where's your next target? Now that they failed the 50, right back down here at this level. Whoops. And Chewy, here's your big evening star signal. Next likely target is the 50. Yes. There's some people that just completely disagree with technical analysis. And then there's other people that think fundamental research doesn't mean a whole hill of beans. Because if, and the old adage, or if I ever hear, when I hear money managers or fund managers say, you can't time the market, I tell people get away as far as possible because you can time the market. JP, hold on to your individual ones until we get done here, which we're almost done. Oh, they beat earnings this afternoon. They are down after hours. Yep. Okay. With that, are there any general questions on candlestick analysis? Fabian, yes, that's why I think candlestick analysis is much more powerful, because it is the graphic depiction of everybody buying and selling during a specific time frame, which is usually 90% of the decision making is based upon fundamental reasons. So essentially, the graphics of candlesticks are just telling you what is everybody's decisions being made based upon their fundamental research. So it's kind of piggybacking on their research. Yes, they'd if you see a signal or a candle acting strong going into a close when they're going to be reporting earnings, you got to figure the people that know what's going on with that company are buying going into the close. More than likely, it's going to come out as a favorable result. Now, I say more than likely. Everything we do with candlestick analysis is giving you the probabilities of what price movements should be doing based upon human nature. But the important word there is probabilities, not guarantee. But anytime I see a candlestick signal, I don't ignore it, because I know the probabilities that every time I put on a trade based upon a candlestick signal, the probabilities are in my favor that I'm going to make money with that trade. I missed your comments on the duration of Saturday. It's 4 hours plus, yes. It's always been advertised as 4 hours, but you'll be lucky if it's less than 5 or 5.5, maybe 6 hours. So we usually start around 9:30 in the morning, go to lunch. We give a generous 20-minute lunch break, and then we come back, and usually we go to 3, 4, sometimes 5 in the afternoon, depending on how many questions there are. Okay, I guess with that, Rick, go ahead and do the double line and try to keep your request to one apiece, or it'll be here until the cows come home. And Rick, in 3.6 seconds, do the next double line. All right, we'll try to shoot through these. Work. Probably if I was short, I'd think about starting to cover the short, but I wouldn't be going long. CrowdStrike, that one you can get ready to go long if it opens positive tomorrow. Because of your doji bullish confirmation, now you're back up. You can see you're back up above the T line. Oops, oh, somebody wanted this. Oops, that wasn't it. Becky, do you want to put the sign up for this weekend back in again? Somebody was asking for it. Sienna, stay short until you see a buy signal. And remember, the further away you move from the T line, the higher the probability. So the first time you see a buy signal, that's when you start covering your short position. Excuse me. NVIDIA, if you're short, you stay short. If you're thinking of going long, you don't go long until you see it close above the T line. Occidental, stay short. Why? As long as you're below the T line, you stay short. Slumberger, same scenario. You can be shorting this one. I think Halliburton was the same thing. Notice your left-right combo gap down, doji sandwich, broke the 50. There's a gap down here that you could be heading for. AGEN, big breakout. Now you look for a 45 degree off of here. F-SLY has been kind of out of the picture for a while. Nothing there. I wouldn't be long or short. This is a sideways. Advanced Micro. This one, if you're short, notice the bearish left-right combo, a very strong reversal. If I see a bearish left-right combo, a lot of the signals you want to see confirmation. A left-right combo, you probably want to get out as soon as you see it. You don't really need confirmation because the probabilities are that there has been a change of investor sentiment. So right now, if I was short, I'd stay short. Ralph Lauren, you can stay long as this stays above the T line. Blink, stay short if you have been short. You don't want to buy until it gets back up a buy signal above the T line. Reggie, you stay long. Use the T line as your stop. But you can see you've got kind of a J-hook pattern. Not quite a kicker signal. So right now, if you've gone long, even if it opened lower tomorrow, you might take profits, waiting for it to come back to the T line, and then see if it's going to bounce back up from there. Oh, is this the oil? That's a toughie. You can get ready to buy this one if it comes back up or opens positive. Just watch to see what happens once you get to the 50. Is the 297 per session or for all 4 sessions? Oh, I don't know what all 4 sessions are. It's 297 is for the 4 to 6 hour option training on Saturday. $197 for members. And if you're a member that has already taken it, you come back for free. Codex, you can get ready to buy this one. It's not quite a kicker signal because it opened below where it closed the night before, or where it opened the day before. But you can get ready to buy this one on positive trading. JetBlue, just stay long. It's not a real vivacious chart, but as long as it stays above the T line, you can stay with it. TWI, be careful. I would be buying on strength because you've already broken out, and it looks like wave 3 is about the same as wave 1. So I'd be a little bit careful here. So this is one where you go back and say, well, where should I have been buying? I should have been buying right in here as it was just starting to bullish engulfing off the T line, just breaking out through this congestion area. And AM, oh, I wouldn't. Edwin, if you own it, yes, I would have been out of this one. Now, this is how I learned candlesticks a little bit more convincingly. If I was holding on to this, I'd be saying, man, this is killing me. Where should I have gotten out? Well, doji, closed below the T line. This is where I should have closed out this position. At this point, if you're short, you can stay short, looking for it to head probably to the 200-day moving average. And PEIX, Another one that's not real vivacious yet, but if it opened positive and traded positive, you can see the J-hook pattern setting up. And look how this came out of. So this is your classic pattern. Make this smaller. Coming out of your fry pan bottom, wave 1, wave 2, getting ready to go into wave 3. And court, boy, this is your berry stick sandwich. Probably if this opened lower tomorrow, I'd close it out. And here's a trick, not a trick, but here's a probability situation. If you've got a big, huge move like this, if it opens lower the next day and closes lower, you close it out. And you don't buy it back until it closes back up above this level. Just the probabilities, if it opens lower after a big price move, is the profit taking will remain until it gets back up above that first initial close. I would hang on to this, use the T-line as your stop. If it closed back below the T-line, you don't have any chart pattern anymore. Silver, nothing. You're sideways. Wouldn't be long or short. And FVRR, that one you can get ready. I'd be more apt to buy it on positive trading, knowing that it broke out with this kind of little slow curve move. CRM, Salesforce, nothing yet. You have an inverted hammer, you have a pop-up to the T-line, but your warning is that your stochastics are still heading down. So I wouldn't be buying this one. If I was short, I would have covered the short. What color was today? Oops, today was a red candle. I'm partially colorblind. So you could still be shorting this one on weakness tomorrow with the information today telling you that you're in a downtrend. Bill, yes, it's a 4-hour plus session. We start at 9:30 and we go, usually we were supposed to quit at like 1 or 2, but they usually go to 3 to 4. Charles, I put out 2 or 3 stock picks every day. That doesn't mean I'm in everyone because I usually keep 10 positions at most in a portfolio or my trading portfolio. But my watch list might be 30 or so because I've put out recommendations that are working. So sometimes my basic watch list, which would include the indexes and crude oil and that type of thing, might be 35 on average. If the market's whipsawing, might drop down to 25. If the market's in a steady trend one way or the other, it might go up to 45 or 50 as long as those recommendations stay above the T-line. Carnival hasn't been able to get back up above the T-line. I wouldn't be long. If you're short, you can stay short. Or if you're thinking of going short, you could probably short this one on weakness. Walmart. What did I do wrong here? Walmart stays short. This is what you call a meeting line. Notice they opened it here, closed it here, gapped it up, and closed it right back where they opened. That's a bearish signal. And look how far away you were from the T-line. If it opened lower and you were long, you closed it out because where do you think the next target was going to be? Back to the T-line. Oh, buy a put on this? You could, yes. With the expectation of going to the 50. Charles, you could, but I don't even bother with the that sophisticated a spread. I just want a very simple one, so I know what I don't want to be spending a lot of time figuring out what to do. when you see those 5 candles drifting downward, we also have to remember that time beta decay is diminishing your profit each day. So consider getting out. Yes. So if I was in something like this with calls, and I'm starting to see that it's kind of not going anywhere, I'm going to close it out and go find another chart that looks like this. The Qs, I don't know what they're doing after hours. I thought I saw the Dow up about 77 points after hours. But the Q's the same as the NASDAQ, sitting right on the 50. We did zoom. Zoom, you stay long, use the T-line as your stop. If you see better signals in your watch list, do you close one of your 10 in the position to make room? Yes, that's the cultivation process. That if you keep moving, if you've got something that still looks okay, but it's already had a move, you've got some profit in it, and it's starting to look a little bit squeamish up in the overbought area, but then you see something that looks fantastic, like a real strong buy, yeah, I'll move the money, because we're not trying to maximize our profit on every trade. We're trying to maximize our profit for the account, which means you should be constantly moving away from the ones that are getting a little bit iffy. Yeah, so if that was telling me I don't know which way it's going, close it out and go find another trade. All right. John, yes. But just with some added strategies. The VIX, right now, if you're short, you stay short. Okay, so right now, the direction of this market should be, I wouldn't doubt if tomorrow they open it, take it down, bounce off the 50 and start bringing it back up. That doesn't necessarily mean it's time to buy. All it means is it probably hit the bottom and there might be some waffling in here for a little bit. All right, everybody. With that, everybody have a good evening. We will see you bright and early tomorrow in the chat rooms. We'll see you then.